Welcome to this tutorial. Let's do some more practice problems. So this is bond amortization using effective interest rate method. Let's say we're a company and we issued $100,000 bonds. That's the face value of the bond, and our yield to maturity is 12%, and the number of years to maturity is 10. The coupon is 11%. So this is what the market want. They want a 12% yield. So if they want a 12% yield, we have to first tell if our bond is selling at a premium or a discount, or how much are we going to receive today to borrow $100,000, which will be due in 10 years from now. So 1, 2, 10. Okay, so this has to be $100,000. So the net book value at the end should be $100,000, because when you receive money today, you're gonna increase your assets by the present value of this future cash flows, or the money you're going to receive. So once your asset has increased, that means your liability has also increased. So let's calculate the net book value of this bond. So how do you do it? How do you do that is you calculate the present value of the bond. Just a rate is the market interest rate, which is 12%. The number of periods is 10. The payment is the face value times the coupon rate. That's your payment. The future value or the face value of the bond is this $100,000, and this is your cash inflow. So this is your cash inflow. This is the cash you're gonna get, and at the end of 10 years, this is your cash outflow, and this comes off the balance sheet. That's because you have paid the interest payments. So what's your if somebody asks you what's the interest cost, so your interest cost is equals to, well, you're gonna pay this, but you received this. So your cost is this. And what we're essentially doing in this is we're depreciating this cost, but that's not we say. We are saying that we are amortizing this cost. We're distributing evenly this expense. I mean, this is going to go in our income statement as an expense, and period each period we're going to see how much expense we have. To do that, we have to create this table, and then we can see how much our interest expense is per year. So the coupon payment is 11 is 100,000 times the coupon. Okay, let's freeze this. How do you freeze this? Is okay. You freeze this. Hopefully, let's see. Oh, no, no. This is good. This. Now maybe yeah, got it. So we're carrying this value, and if we carry this value anytime, we have to pay an interest. Okay, so how do you calculate the interest payment? Well, you take this carrying value times the market interest rate. So this is your interest expense. Okay, half the job is done now. But the part that most students don't understand is this. So pay attention now. So you're paying this coupon payment because you have to pay this at the end of year one. You have to pay $11,000, but your interest expense is 11,321. So you're paying less. So you're carrying this amount. So you still owe this, okay? And this will get added to your book value because you didn't pay for this. You did not pay this amount yet. You only paid 11,000, so you have to pay. So then the interest is getting compounded on this book value. So this is equals to the carrying value over here times the interest rate, which we'll use the market. Okay, and we're gonna freeze this, and the coupon payment is 11,000, but no, sorry, yeah, the interest expense is 11,360, but you're only paying 11,000. So again, you have some balance over here. This is your balance, and it gets added to your book value because you did not pay this. Now let's see what happens if I just scroll this over. Here you see at the end of year 10 we owe them 100,000. This is at any time we can see, at any time we can calculate the book value of our bond. So if in year 11 we want to dispose this bond off, we're going to get $96,395. And at the year 10 the value of our bond is 10,000, and you dispose this off, this balance comes off your balance sheet. So this was your bond amortization using effective interest rate method. And we will see straight line depreciation next time. Straight line amortization. Or so what straight line amortization is, it's expensing your interest cost. This is your interest cost. Let me highlight this for you. This is your interest cost. So how do you expense this in straight line amortization is you distribute this interest expense evenly. What you do is you take this your interest cost, you divide it by the number of years, which is 10. It's going to give you 565. So you're going to have 565.02. You're going to have this in straight line depreciation. This is your interest expense. And you see this is different from what we have. This is using the effective interest rate, which the US GAAP wants you. This is the real way of doing. This is not the correct way of doing according to accounting experts, which can still do this under different accounting standards. And this is your interest using the effective interest. And if you add these, let's see what we get. If you add these, let's see, you get 5,650. Remember, this is equal to your interest cost. Can you see this? 5,650. This is equal to your interest cost. So what we have did is we have distributed the interest expense that in different periods. That's how you do it. Here they expensed it evenly, and look what happens if you add all of these up. Oh, I'm sorry, my Excel skills are terrible. Uh-oh. So we made some mistake. Okay, no. That's what I'm saying. So if we expense this evenly, it's gonna be 565.02. Now let's take the sum of it. Okay, you see? So they're both equal. So this is using the straight line And this whole thing is using the effective interest rate method. So this is hope this video makes a little bit sense. Thank you for watching. Like this video if you think it helped you. Thank you.